Welcome to the show today, everyone. Learn how to make money, learn how to keep a lid on your expenses, and then invest the rest the best that you can. Can it really be that simple, though? I think so. That's pretty much the conversation that I had last week with somebody when they were just trying to put into their mind what was the simplest order to go about how to get wealthy. They were young, and they just wanted to know, what is the general order of things of what I should do first? And the answer is really that simple. Make money and make it grow as fast as you possibly can. Then learn how to keep a lid on your expenses so that you don't end up falling into this trap of constantly just spending money on whatever needs to be spent money on and then treating yourself afterwards with the leftovers. You've got no plan for those leftovers. They're gone, right? So spend less than you earn. You've probably heard of this. And if you want to know the origin of this principle, it's in the book, The Richest Man in Babylon. And it's the first step, and it's the hardest step, I think. Spend less than you earn, because both your income and your expenses will change over time. But when your income and your expenses are optimized, you can generate some leftovers. You have some leftover surplus money. And that money, it's like seed. It's like watermelons, right? And watermelons will spawn more watermelons. And they have seeds in them as well that you can plant, and on it goes. Now, for some, consistent investing, either by using a retirement fund like KiwiSaver here in New Zealand or by buying shares or investment properties in particular, they find that really easy to do, really natural. I know for me personally, I've found getting into investment properties super natural because I remember growing up watching my parents buy property and then driving around neighborhoods, pointing at properties they used to own in the past, saying what they were today worth. And they just kind of reinforced this message that, yeah, property really just goes up in value. So I guess the faster I can get one and the faster I can get another one, the more likely I'm going to build wealth that way. And I think a lot of people know that. And so that's why property is the drug of choice, right? But for a lot of people, there's a little bit of work because they're stuck in this place of inertia, right? Where they need to get that motivation up and they need to make a start. That's really hard. But I'm fairly confident, as someone who's not likely taking a straight line there, that anyone can invest. Really, anyone can. And most investment tools will probably get the job done. Yeah, some are better than others, and some come with a lot more risk than others. But more or less, if you stick to the middle, I guess, you're going to get the job done. But what separates those who play with the tools and those who actually build are those that look at the plans. It's the strategy that makes everyday investors succeed. So property, bonds, shares, crypto, whatever, there are strategies inside of all of those tools. And there are strategies that can use all or some of those tools all at the same time to get the job done. Once you find or once you develop a strategy that's based on your currently available options, then you should start investing with that strategy, and you should stick to it if you can. Even if your strategy is just to make a start, great, let's start there and make a start. Most investments go up in value over time, so maybe it doesn't need to be that complicated. Rather than chase perfect, just get stuck into it, right? The doing and making strategy is the idea of this one today. Before we start, I've spoken in the past about passive investing and not timing the market. Today, it's the opposite. Active investing, timing the market, thinking about the market, all that sort of stuff. Now, I'm not selling anything with these chats on this podcast, so it's awesome. I'm going to cover whatever I want to learn about, so I hope you find it enjoyable and you learn something today as well. And you'll take what works anyway, and you'll discard the rest, and that's fine, whatever. Do relax, though, your pre-existing belief set about your specific strategy that you might already be adapting. It might be working for you. You probably should just stick to it, like what I said before, but if you're trying to kind of still develop a strategy or you're trying to refine whatever you're doing even better, pay attention today if you can. So invest in no more than 50 listed U.S. companies involved in doing and making things for the betterment of humankind. Avoid investments in banks, insurance companies, gold, and bonds. Avoid debt and actively watch the market, not just the share price. Special thanks to my guest, Brian Henry from Always Ethical KiwiSaver. If you want me to catch up with some other KiwiSaver providers, please let me know on the socials. Just hit me up on LinkedIn. All right, let's get started on the show. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow The Everyday Investor on all social media channels. The NZ Everyday Investor podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. So you are the director, co-founder of Always Ethical KiwiSaver. Why don't you tell me a little bit about what you guys do?
Yeah, Always Ethical started out as the first ethical offering in KiwiSaver. So from day one, we set out what our ethical mandate was.
Yeah.
It's always been a written mandate, so you can read it. You can like it, dislike it. The aim of it is to do what's right. So our aim is to invest where it's good for humans, but also remember you've got to get a good return for your investors. And both ethical investments back when we started were considered as failures. They wouldn't make decent money and they were profitable. We've proven that wrong.
So why though?
And it was considered ethical investing was in lesser return type investments. We set up a system where we invest only in listed US equities, and the philosophy is we participate in our investors. Mortgages, things like that, interest products, you don't participate in the risk. You let the person borrowing the money take the risk, and you sell out grandma's and granddad's house if it fails. We participate. So we participate in every business we're in. So we're in ordinary shares, and we're in what we consider to be really good companies, doing good, doing right.
So it's like risk sharing rather than risk transfer.
Yeah, you
That's
participate in the risk. So you're taking the risk with them. And the next thing we did is we worked out some financial ratios that we apply to all investments. So basically no more than a third debt. So very strong balance sheets. And we hit upon a formula which we've found works, which is balancing debt against risk in the market. So while we're a manager of equities, we actually see we're a manager of risk. So we will play between the number of equities we're holding, the volume of cash we're holding.
Yeah.
And we hold cash in the US dollars because we're invested in the US market. And it's balancing that risk that gets returned. So 220, all of the market had a terrible year. We did 24.9%. How did we do that? We did it because we balanced out the risk between equities and cash, and we shifted into a very high percentage of cash. We were 75% cash.
Why were you in 75% cash in February?
Because we saw the market risk too high.
Right.
So we're actually balancing market risk.
Right.
We don't do it on individual stocks. We do it on the market as a whole.
I see.
So right now today we're watching the indices, what's happening, what are the trends, and I'm not worried about the individual stock. They're all great stock. They've all got very low debt. They're all under 30% debt.
Yeah.
I'm not losing a stock. I'm going to lose value in the market if the market moves.
Sure. So you're always moving between these two buckets of listed US equities and a cash bucket, depending on overall market risk, not company-specific risk necessarily.
Yeah. And what a lot of people in New Zealand don't realise is that there is a correlation between the performance of the Dow and the New Zealand US dollar.
Yeah, do you take me through this? Because you mentioned this on the phone when we spoke, but I found this interesting.
There's no logic to it. There's no explanation any of them give. But ever since World War II, if the Dow falls, the US to New Zealand dollar falls. So that means in terms of New Zealand dollars, if you're holding US dollars, your book goes up.
Yes.
So when I said we made 24.9%, 13% of that gain was the currency shift. And that's part of how we came up with the balance in the book. And yeah, the whole aim is we sit in really good, healthy stock. We don't do any of the weapons of war. We don't do gambling. Unlike other funds, gambling means casinos. To us, gambling means having a product that's not based on doing or making something for the good of humankind. Sure. So if you're a derivative, that's gambling to us because your outcome is risk. And you're looking to beat the system purely on chance. And that's a risk. We don't see that as ethical and right. So what we're looking is you participate, you don't depend on chance, you depend on something actually being done, made or sold.
Done, made or sold.
Yep.
I guess depending on how you justify it to yourself, or you can abstract that a little bit and think of almost all investing as a form of gambling if you really want to get super cynical, but you've drawn a line somewhere there.
Yeah, right? we've drawn the line in that we're looking for stock that are making their mark in the world based on the fact that they're doing and making things. It's a service or it's a product they're selling. We're not on one where it's on chance because they're balancing the book somewhere and they're having a gamble on orange juice or whatever they do. We want them actually having income derived from hard work.
So you wouldn't be investing in insurance companies?
Nope.
Right.
Banks? Nope.
No banks, no insurance companies. So basically no financials?
No financials.
Because there's just too much risk in derivatives. It's all mixed in there.
So they're either manufacturing or providing services.
Right.
And it's not financial services. So Goldman Sachs is out.
Right.
Because they just don't need what we do.
Yeah.
But it works.
It is called an aggressive fund, but right now you're 50% in cash. Right?
We shifted to 60% equities, 40% cash. So we've put some money in the last 2 weeks, and we're getting a bounce. That's brilliant.
Yeah.
So the fund at the moment is showing growth at a huge rate, and sell story. Hindsight, I should have put in more. But if the market falls over tomorrow, I'm not going to be worried because I've got a whole heap of cash sitting there, and we will buy into the market, and that will mean in a year's time we will be way ahead of others.
How do you measure market risk?
Very difficult. We sit around the table and we argue like that and we disagree, but it's a collective view of 5 of us.
Sure.
Now, we don't believe in ESG.
Yeah, yes. I couldn't find much reference to ESG on so environmental, social, governance principles. I couldn't find that.
We'll start with governance.
Yeah.
We want good governance. I don't care whether it's Warren Buffett, who's an old greyhead, or some young hotshot kid. If you've got good governance, I don't care about sex, colour, creed,
cool.
Irrelevant. Social and environment, we work on the basis of it's got to be good for humankind.
Humans, not just restricted to planet or...
Yeah. Which is looking at people and looking after people. It's a slightly different focus, but a lot of people say the environment and all these sort of things are important. Absolutely they are.
And so you're kind of taking that, and I guess there's a certain degree of common sense here that it's humans first, right? And so if you're taking care of the humans, then by extension, you're probably taking care of the planet as well, right?
Yeah, but we focus on humans. We focus on the fact that what we're investing in is not taking people to bits by usury, and we're looking at people doing and making something that's worthwhile. And that to us is the ethical position as an investor. Always remembering, your first job is to make money for your people. You might be top this year, you won't be top next year, because it chops and changes. And there's a lot, as we said, there's a lot of, sometimes one company takes off, others don't. Those that, for example, invested in NVIDIA when it started, they've made 3,000%. We didn't start off invested in NVIDIA. They were a gaming company making gaming chips, and all of a sudden they came from nowhere. We have invested in them. We're running with them now, but we were Apple, Microsoft, Google, and those companies have performed really well over a long time. Right now we're looking at Apple because I'm not sure if Apple's run out of steam. A lot of people are worrying about Apple. Since Steve Jobs died, they haven't produced a lot of new products. They make fabulous products, but they're not innovating. They've gone into AI the last few days. Watch them.
Sure.
But so long as we're happy with the culture of the company, we're happy with what they're doing and providing to the world, we tend to let them run. And it's only if we start thinking, no, we don't like what they're doing, we'll sell out, or they take on debt.
Sure.
Taking on debt is the first sign the company's in trouble. We do not leverage our book. I totally find it abhorrent, and I've seen this so many times. Fund managers borrow money against your investment that you wouldn't want to have money borrowed against, and they lose it. 2008, the failures there were all because of leverage.
Right.
They borrowed money against the money, and the banks walked away with all their money, and the investors got left with nothing.
Are you seeing that play out with some KiwiSaver providers today?
I'm not going to comment on other KiwiSavers at the moment.
Almost got you there. Not quite.
I do watch leverage.
Yeah.
And I do have a real concern and teach people leverage is bad. It's up to people what they do. One of our main competitors is Milford. Milford is a really good run company. I don't know if they leverage in their funds, but if they did, I would expect them to run it within a very, very prudent book. And so long as it's prudently done, it's fine. The problem with leverage is it gets out of hand, because as you say, someone who suddenly thinks, well, I can make all this more money because I'll back NVIDIA or I'll back that and I'll borrow it. And then the market turns on them.
Yeah.
And then they've lost the client's money and they can't get it back.
Yeah.
Yeah. With me, if a stock goes down in value, it'll come back.
Mm.
With them, if you lose because of a leverage sale, you've lost your stock, you've lost the money, you've got nothing left.
And there is, I guess, leverage is an interesting word because you can apply it probably some slightly different ways, or because all it means is that the sum of the inputs are less than the sum of the outputs. So you could accomplish that probably by using your intellect and creating a set of ethical principles and sticking to them even when you don't feel like it, because you're kind of putting weight on something external, the principles, rather than your own judgment, right?
That's the trick of ethical investing.
Right.
Is you stick to the principle, even though you don't agree with what the principle is telling you to do, you do it, and you won't go wrong. The moment you break from those principles, you will get into trouble, because they're there for a reason. We established them at the start for a reason. Now, I've been in fund management since 2003 as a side hobby on being a barrister full-time, and we started the KiwiSaver in 2014 with the ethical mandate. And I can tell you straight, the one lesson I bought from all my experiences, you stick to your principles, and away you go. And you get really good advice at the start, you set your game and you play it. And that's what we've done, and so far, touch wood with them.
And that's where, I guess, the investment community helps keep you aligned to that, right? Because you're not necessarily going to be yes people. You're going to have a little bit of disagreement, but that helps you center yourself. So.
We had the supervisor come sit in to check on the committee, and they walked away saying, yeah, that's pretty robust. And we have some really strong arguments. It's about robust debate. It's actually about disagreeing and then finding a consensus.
Yeah.
And we're pretty good at finding a consensus.
Yeah.
And, I sometimes get overruled.
Yeah.
I got overruled in the current investment running. They've increased the book. I'm a bit more conservative at the moment.
Sure.
Much more worried about it falling over. But the balance was, hey, let's start. The answer is it's working well. But I'm happy because I've got enough risk component there if something goes wrong. I've still got 30% of my book that I can buy cheap stock with.
So do you always have to keep 10% in
We'll go to 95%. Okay. We usually hold 5.
Yeah.
Part of that's liquidity because people come, people go. You've got to have money for it.
Yeah.
As you get bigger, that'll get smaller.
Yeah.
But myself, I like having a piece like that because something comes up, sometimes it's worth buying. You can get an individual stock that suddenly has a disaster because something happens. And you look at that stock and you go, my God, that is such a good stock. It is going to come back. So you've got a bit of margin to do it. Our problem is we're only allowed to invest in up to 50 stock.
That's 50 companies.
Yep. The reason for that is you've got to manage your book. So I like to be sitting 45, 46. I can actually, if I see really good opportunity come along.
Sure. So would you kind of call it, would it be almost like a bit of a barbell approach, sort of, where you have your stocks over here, your cash over there, but it's diversified, sort of, but it's just all U.S. equities.
It's just common sense what weight you've got on what side.
Right.
And it literally is, you've got the two balances, you're working between them, and you're just watching your trends.
Sure.
But I'm not playing an individual stock. Yeah, people accuse you of stock picking, things like that. I know. I've got a book. and I'm watching what that book's doing in the market. And that's a total universe market. And to me, it's a case, you're quite right, you're shifting and moving.
Yeah.
But yeah, today's today, tomorrow's tomorrow. And markets are dynamic.
Yeah.
So we're always, every day, just watching them. Where's our balance? The market will fall. And when it does it, if you've got plenty of cash sitting here, you get into the market, and it's all that end,
Yeah.
the market recovers.
Yeah.
And your client does well.
And the opportunity cost of being so much in cash is, I guess that's captured, or it's offset by the gains that you get when those drawdowns happen, and then you start buying.
And the currency play.
And the currency play. So with that, going back to the connection between the Dow index, and the New Zealand dollar. So Dow goes down, New Zealand dollar go up or down. Oh, but the U.S. dollar, because it's going down, the U.S. dollar is worth more, therefore your returns are offset. So you're not hedged at all. Because hedging is not one of the things you don't do. Yeah,
hedging is gambling. Yeah, hedging is a derivative which we don't do.
So this is really hard, I think, for a lot of people probably to get their heads around, because the financialization of most of our investments is so, it's infused everywhere you go. It's really hard to separate it. And like the two edges of the same coin are risk management and then speculation. So your insurance contract on one side, but it's hedging on the other, and it's...
But the US market is built on that innate gamble.
Right.
And we have done something that plays that gamble to our success. We don't gamble on it, we just sit and we play the book straight. And so far it has worked very efficiently. And so long as we keep to our playbook, don't try and be smart.
So one of the things that's on the list of things that you don't invest in is gold. And then, well, one of the things is pork, which that's interesting, right? Like, it's not necessarily considered an investment, but with gold, question around that, interest, we're not going to touch it. Gold doesn't have any interest payments on it. What?
Gold's not an investment.
So why wouldn't it be held as a substitute for at least a portion of the cash?
Gold can be used as a substitute for cash, but people have got to understand what gold is. Gold is something that goes up and down based on what people see, but it's not making or doing anything for the good of humankind. It's just sitting there in a vault.
So it's cash.
Cash is your medium to trade.
Right, medium of exchange, right? So that's your...
You have to have cash as a medium to exchange, but the bottom line is gold does nothing but sit there and look pretty.
I see. Okay, so you would not necessarily consider your cash as an investment per se then. No. It's just an immediate, it's the ability to acquire.
It's a trading and moving medium.
I see. Yeah. Okay. Because I think that it gets problematic sometimes depending on how far you go down that road, right? Like even you could say, well, the US dollar, if you want to pick the most unethical investment in the universe, it's the US dollar.
People say that. Right now you've got this whole group trying to break the US currency as its trading currency. That block's working away like mad on it. Our views are not going to succeed, but things will happen. But it is the medium of trade in the world, and we have to have a medium of trade. So at the moment, we use the US dollar.
If it all of a sudden did, so let's say the BRICS Plus nations did actually succeed, and now the US dollar was fading faster than expected, like I personally agree, I don't think we're going to see that anytime soon, but over a long enough time frame, perhaps it's inevitable. At what stage would you make arrangements to diversify to the US dollar?
Well, at the moment, we only invest in the US stock market, and that's because it's got the only liquidity that's acceptable to us.
Yeah, right.
The New Zealand stock market was discounted because there's just not the liquidity.
Yeah.
I need to be able to sell my book out 100% overnight.
Yeah.
Which I can do and have done. If I feel that's what needs to be done to look after our investors.
So it's very simple, isn't it?
Very simple. I can drop my whole book in 5 minutes if the US market's open. Gone.
So that's something.
And that means if we really get worried, and my earlier funds, which were similar structures, before the GFC, our analysts picked up that Goldman Sachs or someone was up to something in the market.
Right.
At 3 o'clock in the morning, we were in the office and we sold out. Those days it took 15 minutes because we had a different brokerage arrangement, and now I can sell in 5.
Is that right? Yeah.
And we did. And we got summoned by the auditors the next day to come and explain. And we said, something's going wrong. 2 days later, Goldman's came out and said, oh yeah, we sold all this stuff.
Yeah.
And you've got it, you've got everybody else got swung like this, and 2008 was on. But we picked up the shift in the trading volumes. Something was going on here. And they, that night, took $2 billion US out of the market, and the market didn't even recover. That's liquidity. So
You're not going to get that in New Zealand.
nah, or Australia.
Yeah.
None in the world.
Sure.
Nowhere matches, even Europe can't match the liquidity of the US market. So if the US market loses that, then we'll be shifting, moving. But we're with the US currency so long as you've got a market with that degree of liquidity. Most of the good companies in the world that we're interested in are listed somewhere, NASDAQ,
Sure.
New York Stock Exchange.
Okay.
And that's where we go. There's a couple we can't get because they're in Europe.
Yeah.
But so what? I don't want to have another currency.
Sure.
So we specialise in watching the US market. That's our walk. We watch 50 stocks tops. 3 of us work the investment committee. And we're pretty bloody minded the same ways.
Yeah.
And we come in with recommendations, and that's when all hell breaks out before we get the agreement. They don't agree with us.
That sounds good. Well, that's kind of what you want, right? You don't want...
That's what you want. You actually need that robust debate.
Yeah.
Because it stimulates you.
So let's kind of talk about my industry a little bit. I'm a financial advisor, as you know, and this whole space interests me of fees, performance in terms of returns, advice. How do we kind of square all these things away, and how do we actually help people make good financial decisions and grow wealth when most financial advisors, and forgive me, other financial advisors who are listening, we're salesmen most of the time, right? We're flogging products. So how do we square that away?
I go way back in this debate because I wrote an article called Death of a Salesman that our financial advisors. But nobody gives independent financial advice unless they're totally paid for by the customer, and they're totally independent, and they totally research the market, and they don't depend on a big company to give them research. That's salesman, full stop. We do not have any associations with any financial advisors. We'll sell direct into the market. We've got some financial advisors who will sell our product, but we have a couple of philosophies. The first is we don't get into financial advice. You either love us or you hate us. And if you don't like us, I don't want you in my book. I'm serious. If someone rings up and says, oh, we don't like you, don't you? Just we'll sell. We transfer. I don't care. I don't want you. If you like what I'm doing, stay with me.
So you're not necessarily going to bend to what the public opinion is on a certain matter and then sell out of certain stocks just because that's what your members want.
We follow the rule. And the rule book is we follow our work and we keep to it. The big debate is fees. And certain people have got out in the market, and the FMA is the leader of this, who say low fees means better returns. Well, look at the last 10 years, and they're wrong. From my experience, people doing their job should be paid a proper fee, and people doing their job, working hard, managing risk properly, are worth more than people who are just buying a book somewhere and hoping like mad that BlackRock or someone like that's going to look after your money properly. A fund that's just sitting there passively will never get it right. They'll fall off the cliff, they'll climb again, they'll fall off the cliff, they'll climb again.
Blame it on the market.
Blame it on the market, yeah. But the bottom reality is it's their management style.
And you guys are active managers.
We're active
clearly.
Managers.
Yeah.
And I'll come back to Milford again. Milford's an active manager. Milford is worth the money you pay. Milford's returns, like our returns, are above anybody who's sitting on a low fee across the platform products.
Yeah.
And I personally believe a good manager, 9 times out of 10, will be ahead of the platforms.
And those who work deserve their pay, one of my favorite proverbs.
Absolutely.
So
and
fund managers and advisors alike, but they're doing different things. Yeah.
But, who gets up at 3 o'clock in the morning and watches the start of the US market? Hey, I do. And, quite regularly.
That's why you look like this for a 25-year-old, right?
That's right.
Yeah.
I get quite worried about things, and I honestly am up at the start of the market to watch what's going on.
Yeah.
And you look at the futures at night when you go to bed and you say, don't like to look at some things going on. There's clouds on the horizon or whatever. Other nights you stick like a log because you know where it's going to, you don't worry. But if you know where the market's going, that's great. If you don't know where the market's going, why do you invest in it?
That's what I mean, I guess, with, depending on how far you go down the spectrum, like a lot of times when we're investing, we are gambling, especially when we're disassociated from it and we're really just solely, exclusively interested in number go up. And that, I guess, passive investing to a certain degree, that's kind of what that is, right? Because you don't actually engage at all with what you're doing. You're just expecting more money to come up.
You just sit and expect it to do what it did yesterday.
Sure.
And you wonder, well, it didn't work yesterday. Why do you expect it to work today? You have to think, why didn't it work? How do we improve? What do we do? How do you adjust your book? What industry sectors are you in? Are you in the wrong sectors? Because, industry is broken up into sectors, and sectors perform and sectors don't. And we're only in a limited number of sectors because we're not in finance. We also are not in utilities because utilities have too high a debt ratios.
Interesting, okay.
And that kills us. So I'd actually, we've got one stock that's a utility I'd love to invest in, but it's in nuclear power. That's illegal in New Zealand. So I've got a very good utility stock that does come within my mandate, but it's got nuclear power. Personally, I don't have a problem with nuclear power. Nuclear weapons, different issue. Nuclear power, I have no problems with that environmentally or anything like that. It's making something for the good of humans. It's criminal to invest in a nuclear power plant from New Zealand.
Oh, shoot. Hang on. I'll be right back.
But no, we had an incident about 6-7 years ago, and someone piped up saying, KiwiSavers are investing in nuclear power plants. So there was get out of it quick. We should write back saying, no, we're not.
I remember that now. So no investing in nuclear power. That's right. Note to self. Okay.
But the thing is that those are crazy governance things imposed by a government.
Yeah.
But it's a good company, well run.
Technically, it's good for the environment. It's doing and it's making, isn't it? And that
doesn't have big coal power stations, which some people don't think is so good. But electricity is a good product. It's good for humankind.
The best products.
Well, without it, you would have absolute starvation.
Yeah.
And whether you like it or not, the modern world, unfortunately, depends entirely on oil, coal, electricity.
Energy. So talk to me about the commonality between the three Abrahamic faiths and how that has created the set of guidelines that you guys abide by.
I was brought up a strict Presbyterian. Wasn't church going, but I was taught low debt, don't borrow money, very conservative investing, and that's what was drummed into me from wee child. So for me, I set up a fund called the US 50 Fund in 2003, and we ran that as a investment fund for everybody. When we moved to KiwiSaver, which was 2014, we came up with the concept of an ethical mandate. And when we first looked at the type of mandates around, it became very clear that what I was taught covers all the faiths. Low debt. Don't lend money. And if you're going to help people, participate with them and take the risk. And that's where it came from. And we developed from a invested everything fund to one where we took out interest.
Sure.
And I've seen the damage it's done over the last 50 years in this economy. I was involved in the BNZ when it fell over, acting for people who had borrowed money from the BNZ, and they just absolutely crashed the market. Farms sold out, parents' farms sold out. The damage that was done, the human damage, the suicides, the deaths, and I'll never forget that.
It's not something that we talk about too much these days.
No, but it happened.
Yeah.
I was right there. Unfortunately, clients I was acting for died. And there was a group of farmers who got involved in Forex loans. And they just got killed. The currency management fell to bits, and they had debts that just skyrocketed. I've never seen anything worse in my life.
Yeah.
And as a litigator, we couldn't do anything about it.
Right.
That was horrible.
Yeah.
So, those sort of experiences mount up. And when you're running an equities fund, the first thing that hits you is, right, low debt. So we needed sensible ratios. So we hunted around the world. And funnily enough, even the Christians didn't believe in borrowing money. That changed somewhere along the way.
Yeah.
But the other two faiths still are very much, you do not pay interest.
Yeah.
Usuries are very cruel.
Well, yeah, I guess that it's debt slavery.
It's debt slavery. And
it is a form of slavery.
That's where we came from. So we decided, right, no, we will get away from that. And we sat down with a man called Brent Wheeler, who's probably the youngest PhD in New Zealand's history, ex-treasury, things like that. Very bright guy. And we showed him the formulas we had. And he just looked at me straight and he says, you don't really like what you've got. What do you mean? And he explained to me how you use the ratios that I've been talking about. We've been doing it ever since. That was what triggered the whole thing off as to how we managed and what.
Sorry, US
50 fund.
Yeah. You ran a screen.
Ran the ethical screen over, yeah. That was the difference. And it was a debt ratio screen.
Yeah.
And I don't need to worry about balance sheets anymore.
Yeah.
Every stock I'm in's balance sheet is absolutely secure.
Yeah.
Because the debt's so low. And all of a sudden you've got,
yeah,
I've got a really good product here.
We haven't really even touched on this, but just from a risk point of view. So risk defined as, I guess, the probability of loss or probability of significant drawdown, volatility.
Yeah.
The return that you're getting in light of the risk that you're taking is very, very high, right? Like your Sharpe ratio would be very good over this because of the loading to cash, right?
Yeah.
So when we are, as KiwiSaver investors are looking at all the providers out there, one's providing this return, this one, that one looks good over there. Seldom are we thinking about what level of risk they're taking. Are they using leverage? Are they hedged or not? What is their investment style? Is it passive? Are they just repackaging passive products and slapping a fee on it? Are they taking credit for what the market's doing? All that sort of stuff, right?
We always take credit for what the market's doing, but we get into a funny point here on this because under the PDSs you have to have your risk.
There's the product disclosure statement.
Yeah. We're at 7.
You're at 7.
Because we're an equities fund.
Yeah.
But we've also got a currency factor built in. Now, just based purely on equities, we're about 5.6 at the moment.
Okay.
But then because you've got currency, you can't but be 7 on the way they calculate risk.
Is that because it's not hedged?
That's not hedged, and it's equities, which compared to having a mortgage and you're invested in the mortgage and getting interest every week. You see, in 2008 when we had the big failures, they were all mortgage debenture based products. So their risk was 1 and 2 because no one was looking at the underlying risk. And they lost all their money. But they still only got a risk here because it's interest and they're going to honour the contract. Well, they didn't honour their contract. So that's your first risk issue. This next thing is if you go to Sorted. Sorted has got a risk based on your equities percentage.
Yeah.
At the moment, we are showing ourselves as fairly low risk. A few months back, we were at 70% cash, 30% equities. We're a conservative fund in Sorted. But we're not. We are an ultra-aggressive equities-based fund who tomorrow morning can be 100% in equities. So we're right down at
very different. Yeah,
so nobody else does this.
Yeah.
And the thing is that's where we've broken the paradigm on how we work. So liquidity for us is now suddenly very important. As I said, I can literally go to the office now, type out an email, get it authorised through our stuff, and come 2 o'clock in the morning when the market opens, I'll be 100% cash and I'll be within 1 or 2% of the value I told you today. No one else can do that. Not even a bank can do that. So we get these liquidity checks coming through from the FMA. Well, that's fine, but they're doing their job. Our liquidity is better than any other fund in the world, partly because we're small. We don't debt the market. When we hit 2 billion under management, we'll start to have impact on the market if we did a high-speed sell. But I saw Goldman Sachs sell 2 billion into the market in one night. And the market didn't shift until they told the market what they did.
Sure. Yeah.
So that liquidity is huge.
Yeah. Is a product disclosure statement helpful for everyday investors?
The whole thing is, as I see it, and this is my view, the product disclosure statement is supposed to be a simple statement people can read and understand what it is you do.
Yeah.
The SIPO is your complex document.
Just a statement of investment.
And that is supposed to be a more technical thing that an advisor can read. But at the end of the day, explaining in simple terms an investment is just a task beyond human writing. And people have to sit and talk, have it explained, understand it. Now, you're learning things about my product that you didn't see in the PDS.
Correct, yeah.
If I wrote a PDS, all of a sudden it would be a 300-page document. And the FMA, when this legislation was devised, wanted this really simple document. I find it brutally too simple at times, but they want it so that when someone reads it, they actually get just the nuts and bolts, and that's probably all you can hope for out of a PDS.
Right. So for investors, they need to do a little bit more digging around.
Yeah.
Jump on the website.
Yeah.
Check out what they're...
Websites are great.
Yeah.
I think websites will become a bigger and bigger means of communication than PDSs.
Sure.
But you've still got to have a base document.
Okay.
You've got to have something. I hate to say this, but years ago I was told by an accountant, when you're issuing, in those days, as a prospectus, nobody reads it until they come to see you. And that's true. Most investors have a quick look at it. They'll look at the risk indicator. They'll get a bit of a feel. But human communication doesn't allow that in complex products. Sure. Yeah, mine's a simple product, but it's actually complex because of its simplicity. That's just the reality of where it is. And I go to meetings all over the place, and people say, "Oh, well, first, what's a derivative?" So you talk about what a derivative is, and you use examples. All right, let's talk about orange juice futures. You don't own an orange and you don't own juice, but it's orange juice future. But no. And I say, okay, compare it to a game of poker. You've got 4 people playing poker. You're standing on this side, someone's standing on that side. And you can see the hands. And someone on this side says, I'll bet you $1,000 he's going to win. And you can see the hand, I'll take that bet. That's a derivative.
Yeah, right.
Because you're not in the game.
You're outside.
It's the liquidity of these 2 people to pay up on the bet.
Yeah.
And they sit there and they go, oh, we didn't know that's what people are investing in. Yeah. But I tell you what, the average Kiwi hates it.
Once they realise what it is.
They realise that it's nothing more than playing on someone else's ability to pay.
Well, and it just speaks to the broader truth, I guess, as well, is that most Kiwis, when they are investing using some other service, like using a fund manager, whether it's KiwiSaver or otherwise, would like to think that the fee that they're paying is going towards that provider, maximizing the likelihood that they're going to get more money than they put in at some stage. But there's still a lot of variance in how that is achieved. And I wonder, with the reason why I was asking about the product disclosure statement, the PDS, is because I just wonder how much of the regulation, how much of the oversight with how things are structured, how much does that actually help things versus sometimes occasionally get in the way?
I think it helps more than it hinders, because it does outline the product. And what we find is that we will have people ring up and say, I've read this, please explain. So it starts a good conversation. And we're allowed to explain our product, even though we're not financial advisors. We can explain our product and how it works. And I find if I get in a room with a group of people and I explain how it works and they understand it, 9 out of 10 will invest. Simply because once you get through and you actually understand the simplicity of it and what we do and why we do it, it makes common sense. And at the end of the day, investing is nothing but common sense.
So on the topic of common sense, you feel like you're a pretty common sense sort of guy. I'm pretty sure you came out of the box like that, but you probably would have went through the school hard knocks yourself. Do you want to give me a little bit of background as to where you were before you mentioned 2014 is when this fund started?
But before I started working in investment management, and that was 2003, 2004 when I got into it, and it was a hobby off the side of being a barrister. I had come through, as I said, in some capacity acting for people at every failure since 1972. 1973, I actually started in a job, and I got involved in the JBL 1972 collapse, and I was carrying the books in the criminal trial.
For our audience, give us a bit of background as to What was involved with that?
JBL was a series of syndicates to do with fishing boats. People invested into these syndicates, and basically it couldn't make the money it sent, and it went broke. And next was Security Bank, again, another finance company. People invested in the way they went, it goes broke. And then it goes broke, and then it goes broke. And you get up to the Equity Corp days, you get up to all those companies in the 80s. I can remember walking to work before the 80s crash during the week, and you'd see guys with bottles of Moët falling out of pubs drinking them at 10 o'clock in the morning, all with their little beepers on because they were playing the stock market, and their Black Monday was gone.
Yes, we're referring to the 87 stock market crash.
Come Monday morning,
Black
87, black and white. Why? Because one man couldn't meet his margin call with his broker, and it was so big the broker couldn't meet the margin call with all the brokers in New Zealand. That's why it fell. One man. And that makes you realise the vulnerability of these markets when they get that high or that hyped is really dangerous. So good companies survived. Bad companies were gone.
So you guys saw this from the inside out, from your very first professional experience, right?
Yeah.
You saw that over and over again. You were reminded of this, this interdependence when you're building on a house of cards, leverage upon leverage.
So start the US 50 fund. First thing, no leverage. Right. 2008 comes, and I can remember this really well. The world falls over, and this lady turned up, and she would have been in her 70s, and she was in absolute tears. She had got a $120,000 payout from her super fund, and she'd invested it. And they put $25,000 across 4 of the so-called investment funds, and the final 20 to us. And she actually wanted to go on a world trip. I can remember that. And husband said, oh, no, we should be prudent to invest this for our future. And so she agreed. She came walking in tears, and she just said to me, have you got our money? I said, yeah, got your money. What's your problem? She says, oh, we've just visited the other 4. There is not a cent left. And we actually pull money out on the spot because we can redeem money out on the spot. We're that liquid, it's not a problem. And she walked away with, I think, about $10,000. And she just couldn't believe they actually had some money to live. They lost everything in those funds.
This is in 2008, or is it in the
2008? And that's because of leverage.
Yeah.
And those finance companies and what they were doing were leveraged out. They were all in the same investment, even though they were so-called diversified. They were the exact same motor driving them. We had a different motor. We survived.
Right.
Now, all the legislation you got now was to deal with what those people did. And we now live with a regulatory regime, but we were doing the right thing. And Milford's the same as us. They did the right thing. They didn't lose all their clients' money. But we all have to live under this regime because of what was done by a bunch of cowboys.
Sure. What you were saying is that, yes, all of the extra regulations that we have right now is good, but they are looking for the problem and where the problems were in the past. Not to say that that's not possible for it to happen again, but there's definitely problems that could come up in other places as well, right?
But this is a cost on top. People look at fees, but they forget there's a supervisor fee on top. There's the regulator fee on top. We have got quite a mountain sitting on top of our investors to make returns. So when you turn around and say, this is your return after fees, expenses, but before tax, you're actually covering off all those costs. The expenses is often as big as fees.
And if investors were following the principles that you guys follow as a fund manager, would some of and if they were operating with the same standards and protocols that a fund manager would have, like you guys, would the regulation therefore kind of be redundant?
I wouldn't have a job. They wouldn't need a fund like me if people would just follow common sense rules.
Yeah.
But the thing is that you actually have to be alert and watching all the time. You can't afford to go to sleep on it. That's where people fail.
Yeah.
Because they try and do it themselves. They're running full-time jobs. They're doing this, they're doing that. You have to have that team that's monitoring what's going on in the trends.
Yeah. Okay.
And we have a full-time staff that does that.
Okay. So going back to February 2020, you were like, what was it, 70% in cash? Were thereabouts? You were seeing things, making you nervous, moving more to cash. What do you see today that you mentioned before that you were a little more conservative than maybe the others on the team at the moment? What are you seeing at the moment?
The market today is doing some extraordinary things. The tech growth, and it's the NASDAQ that's growing like mad at the moment. Those stocks are really performing. The Dow is still slipping away a little bit. So you're still seeing stocks doing and making something, prospering. And the US economy is incredibly resilient. The 2008 fall over came about 3 years after it should have fallen over. But every year I can go and get you an article, the beam's here, doomsday's here, all the writers are out there with different views. You've got to look around those views. At the moment, we see the market is performing, but we're cautious. That's why I've got 30% cash. And my picking is at the moment, if we get a big correction, they call it corrections, not crashes, and they come up with,
It's a cost of living crisis.
It's a crash.
We're used to it.
Right, it's a crash. But if the market does have a big event and it really drops, I can bang 30% cash into that market, and those stocks will recover because the stocks I'm in, I'll be buying the same stocks, or I'll be buying new stocks. I've got stocks that I believe will recover if it falls over. So the loss I have on the 70% will recover, but I've got another 30% cash I can put in somewhere towards the bottom, and away it goes.
Okay. And I think a lot of people listening to this would probably go, well, I would pay for that. And so,
right.
Yeah, and so going back to that relationship between fees and performance, we have a track record, so you can kind of say, well, hey, yeah, it's going to cost something because we're going to be up at 3 a.m. occasionally, and that's expensive. Definitely be expensive for me if I had to get up that early. So I get it, but I think sometimes that's a little bit misunderstood and maybe misapplied depending on the fund manager style, because sometimes the performance of the market as a whole goes really high, and yeah, you're paying quite a lot for that performance, but is it really attributable to the fund manager or to the market?
You at the end of the day, it's all the market and how you read the market. You don't want to have a trader sitting at 3 o'clock in the morning buying and selling shares. That to me is folly as a fund manager. What you're doing is you're looking at trends. So it's the market, but it's our reading of the market trends that we do.
Trends are your friends.
You have to have discipline. Yeah, the spur of the moment, oh, that's happening, you'll lose money.
Sure.
There's
always something happening.
Follow your principles. You won't always win.
Yeah.
But so long as you're winning 60% of the time, your clients are doing really well.
Okay. I don't have any more questions, Your Honor.
Sure.
I think we're all good. But
good discussion.
Yeah. Is there anything though that you'd want to say to the everyday investor who's maybe listening or watching it?
I think the one thing is that our philosophy of participating with where we invest the money, participating in the risk those people are taking, is a very sound approach, particularly where you add the fact that we're participating in people who are doing or making something.
It seems to be coming up a lot. It's all about the doing and the making.
It's doing and the making, because that teaches we're not into speculating. That teaches we're not into gambling. You're actually investing in cash flows from people who are in the business working.
And that's risk sharing.
That's risk sharing.
Because you're involved with them rather than a derivative of speculating around the edges of it.
But you can go to a shop and you can walk into an Apple store. You'll see how well Apple's doing, because are the registers ringing or are they silent? If they're silent, I'd be very worried about Apple. Well, the whole thing is they're doing and making something. Does the public want what they're doing or making? And if it doesn't, guess what's happened to that stock?
This is a good chat, and I really appreciate it, Brian. Thank you very much for coming on the podcast.
Pleasure.
And if you want to learn more, like where's the best place? Maybe perhaps we could even give them the website. Where would they go if they wanted to learn more?
Go to alwaysethical.com.
And that's always-ethical.com, right?
Yeah. Okay. If you miss the dash out, it'll still come up.
Okay, that's good. All right, thanks again, Brian.
Okay. Then.
Cheers.
Thank you very much. Thank you.
Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.